Hey everyone, and welcome to today's Explainer. So I want you to step into the date of May 25, 2026 with me, because we're going to unpack what is easily one of the most fascinating, highest-stakes scenarios playing out in global commodity markets right now. Just beneath the surface of all those daily financial headlines you scroll past, there are these massive, completely invisible structural forces that are just aggressively compressing the global silver market. And listen, we aren't just talking about your everyday, run-of-the-mill price fluctuation here. We're literally talking about the physics of a market, its real-time potential energy just being stored up. Whether you're an investor, an engineer, or honestly, just someone feeling the everyday pinch of inflation, this absolutely matters to you. Today, we're going to reveal exactly what is winding this spring so tightly, and more importantly, what the data is telling us will happen when it finally snaps. You know, there's a quote I've been thinking about a lot lately. There's a particular kind of silence that precedes collapse. It's an eerie thought, right? Because that isn't the silence of peace. It's certainly not the silence of resolution. It's the silence of a world holding its breath, just waiting to see exactly which way the fault line is going to break. If you spent last week listening to financial commentators telling you the markets were calm and unremarkable, well, you kind of missed the real story. What happened in the silver market recently wasn't an absence of drama. Actually, scratch that. It was the exact opposite. It was a system under such historic, deeply compressed pressure that ordinary instruments could barely even detect it. Okay, let's dive into this. $77.80 an ounce. That was the opening price on Monday morning, May 25th. Now, it's already a 3% jump in a single session from Friday's close of $75.52. Last week, silver's trading range was incredibly narrow. We're talking a span of less than $4, with average daily swings barely even registering a single dollar. But don't let that fool you. That tiny corridor was a total illusion. It was essentially masking two massive, completely opposing forces just violently pressing against each other with the full weight of global geopolitics and industrial civilization right behind them.
To really wrap your head around what's happening with silver right now, you've got to understand what I call its dual-engine architecture. See, silver doesn't just answer to one master. The first engine is monetary. It's human civilization's ancient store of value, and it's heavily dictated by Federal Reserve rates and inflation. The second engine, though, is industrial. Silver is literally the most electrically conductive substance known to man. It is absolutely irreplaceable. We're talking solar panels, electric vehicles, and the absolutely massive ongoing build-out of AI data centers. Right now, that industrial engine is just screaming higher, running red hot. But the monetary engine, well, it's completely stalled out.
And the sheer scale of this industrial demand, it is honestly staggering. The Silver Institute's World Silver Survey for 2026 just confirmed a sixth consecutive annual supply deficit. We are looking at a 46.3 million ounce shortfall in a single year. That brings the cumulative shortfall since 2021 to a massive 900 million ounces. Now, annual mine output sits right around 820 million ounces. But here's the critical detail you have to remember. 72% of that silver is literally just a byproduct of copper and zinc extraction. Meaning you can't just build a new silver factory or easily dial up production just because prices are high. The supply is fundamentally, structurally rigid. But wait, it gets crazier, because if that structural deficit wasn't enough of a headache, we've got to factor in a massive new multiplier. On January 1st, China went ahead and implemented export licensing restrictions on refined silver. This single policy move effectively yanked 60 to 70% of globally refined silver right out of international availability. Just think about that for a second. You really don't need an economics degree to figure out what happens when you strip up to 70% of the refined supply out of a market that's already been bleeding a huge deficit for 6 straight years. The industrial fundamentals alone are screaming that silver should be sitting somewhere around $95 or $110 right now. Definitely not the $77.80 we saw at the Monday open.
So you're probably asking, why the huge gap? Why the disconnect between the price and this crazy industrial reality? Well, it all comes down to a geopolitical stranglehold that has completely choked out the monetary engine. Ever since the Middle East conflict kicked off on February 28th, commodity markets have basically been held hostage. Iranian naval actions effectively shut down the Strait of Hormuz. Boom, oil instantly crosses $100 a barrel. Energy prices surged nearly 18% over last year. And that massive energy shock, it fed directly and ruthlessly into April's consumer price index, hitting 3.8%, which is the hottest inflation print we've seen since May of 2023.
And the 3.8% CPI reading completely flipped the script for the Federal Reserve. They went from planning rate cuts to holding steady to suddenly threatening actual rate hikes. The market is now pricing in a greater than 55% probability that we see rate hikes by the end of the year. And when the expectation shifts to hikes, real yields rise. Suddenly, the opportunity cost of holding a non-yielding asset like silver instead of a safe treasury bond becomes very, very real. This is exactly why the monetary engine didn't just stall out, it was shoved directly into reverse.
But watch how wildly sensitive this market actually is to the mere prospect of that monetary engine turning back on. On Wednesday, May 20th, Donald Trump tells reporters the administration is in the final stages of a deal with Iran. Instantly, oil crashes 5%, closing below $100, and silver just jumps. But then, literally 2 days later, Marco Rubio steps up and cautions that actually no deal has been finalized. What happens? Oil climbs right back up, and silver surrenders every single dollar it had just gained. This dramatic back-and-forth whipsaw action proves the market is agonizingly trying to price in the exact timing of a geopolitical resolution.
Now, what's really interesting about this is the math, specifically the ratio arithmetic. If that geopolitical resolution actually happens and the monetary engine fires back up, the math becomes totally wild. Major global financial institutions like Krupp are already targeting $110 for silver in the second half of the year. Right now, the gold-to-silver ratio is hovering around 58-1, but if we see the kind of historically precedented bull market compression down to, say, 45-1, and gold hits a fairly conservative institutional target of $5,400, silver crosses $120. If it compresses all the way to the 2011 peak level of 35-1 alongside aggressive gold targets, the math leads to numbers that would have seemed completely fantastical just 2 years ago. But today they're simply the result of mechanical arithmetic.
And speaking of mechanical arithmetic, we absolutely have to talk about the COMEX market structure. It's the world's primary trading hub for metals, and honestly, this is perhaps the most concerning piece of the entire puzzle. The physical coverage ratio currently sits at a dangerously low 13.4%. What does that mean? It means the vast majority of the silver traded on the exchange, nearly 87% of it, is just unbacked paper silver. It is entirely disconnected from the actual deliverable physical reality.
So the crucial point here is this multiplier, 7.5 times. Imagine playing a giant game of musical chairs, but there's only one chair for every 7.5 people in the room. That is the paper-silver market. For every 1 single ounce of actual physical silver sitting in deliverable form at the exchange, 7.5 ounces of paper-silver futures have been sold. This isn't some wild conspiracy theory. It is documented market structure. It acts as a massive pressure valve, and the longer it holds, the more explosive the release becomes when, and it is a when, not an if, the physical market eventually demands delivery in quantities the paper system just simply cannot accommodate.
So, how does this pressure valve start to release? Well, we're actually starting to see the geopolitical and macroeconomic pins slipping a little bit. On Friday, the University of Michigan consumer inflation expectations dropped. The 1-year fell to 4.5% and the 5-year to 3.4%. Now, I know 0.2% might sound like absolute noise to you and me, but for a hyper-vigilant Federal Reserve, direction matters way more than magnitude. It's the first genuinely encouraging data point they've had since February. Add to that the physical reality of oil tankers quietly beginning to test the Strait of Hormuz again and Arab states actively lobbying for an agreement, you can see the direction of travel is moving toward a resolution.
Which brings us to what's coming next. We have an incredibly densely stacked sequence of high-impact catalysts sitting directly atop this market. On Thursday, May 28th, we get Q1 GDP and jobless claims. This is huge because the Atlanta Fed model was tracking Q2 growth at a very healthy 3.7% right up until that energy shock hit the consumer economy. Then, looming just ahead of that, is the June FOMC meeting. And hanging over literally all of this is the pending resolution to the Iran negotiations. Make no mistake, any single one of these events can easily move silver 5 to 10% in a single trading session.
I mean, the June 16th and 17th FOMC meeting is undeniably the most critical event of the entire summer. The Fed's dot plot, their visual roadmap for future interest rates, hasn't been updated since March. When they meet, they are going to be staring down a really stark stagflation dilemma. You've got a 10-year Treasury sitting at 4.59%, and the echoes of Moody's downgrading U.S. sovereign debt from AAA to A1 are still rattling the bond market. Because the market right now is heavily pricing in restrictive rate hikes, if even just 3 or 4 committee members shift their dots toward a slightly more dovish stance, it would trigger a massive, dramatic upward repricing of silver in a matter of hours.
Now, to maintain our intellectual integrity here, we impartially have to look at the binary nature of this setup. Planning for the downside is just basic risk management, right? If talks publicly collapse, oil will absolutely rocket past $110. Rate hike probabilities will push near 70%, and silver will almost certainly drop to test its structural floor of $70. Now, that's a floor that has stubbornly held since the March 23rd panic low of 61, but it's still a drop. But on the upside, if a deal gets signed, the monetary engine restarts, perfectly aligning with a screaming industrial engine in a market defined by 6 years of deficit and a 7.5 to 1 paper leverage ratio. That scenario doesn't result in a polite, gradual adjustment to fair value. That results in explosive, violent price discovery.
Just a quick reminder, we share all of this purely as an explainer for educational purposes, to give you a solid framework to understand what you own and why it matters, so you can make your own decisions with your own risk. The true fundamentals of the silver market have been totally buried beneath geopolitical noise for months now. But as history constantly shows us, every conflict eventually finds its resolution. So I'm going to leave you with this final provocative thought. When that geopolitical noise is finally stripped away and the undeniable structural reality is permitted to reflect in the market, are you going to be caught off guard sweating the daily price, or will you have understood the architecture all along? Thanks so much for joining us for this explainer, and we'll see you next time.